The white clapboard houses that lined the streets of my childhood town told a story. They stood as monuments to the hard-working folks who built them, the electricians, the plumbers, the factory workers whose calloused hands represented the backbone of America's labor force. In those days, a man could support a family on a blue-collar wage, joining the local union and enjoying decent benefits with assurances his job would still be there next week, next year. Those quaint memories seem almost mythical by today's standards. Our 21st century economy has ushered in turbulence that would have been unfathomable to previous generations. Jobs appear and vanish with head-spinning velocity. Entire career paths get upended by technological disruption or shipped overseas to insatiable low-wage markets. The once reliable path to a middle-class life is strewn with potholes and detours. And yet, America's labor market remains resilient, continually shape-shifting to the contours of an ever-evolving global landscape. The latest employment figures, slated for release this week, are expected to illustrate this perpetual churn, with job growth moderating and wage increases decelerating amidst broader economic headwinds. This dynamic is the subject of intense scrutiny for policymakers at the Federal Reserve, who have spent over a year aggressively raising interest rates to tame stubbornly high inflation. Their strategy has centered on cooling an overheated job market and reining in escalating wages that have fueled rampant price increases across the economy. Central bank officials now find themselves at an inflection point. Having lifted borrowing costs at the most rapid pace since the 1980s, they signaled this week a likely pause in rate hikes as they assess the full impact of their actions on the complex employment ecosystem. Some see the nascent slowdown in hiring and wage growth as the first signs their policy is gaining traction. To others, it's evidence the process of moderation has already gone too far. The employment report due Friday from the Labor Department is expected to show U.S. companies added 175,000 jobs in July, extending a gradual deceleration in payroll expansion over the past year. While still a robust pace of job creation historically, it would mark a step down from June's 206,000 gain and represent the slowest monthly increase since the pandemic disruptions of early 2020. Perhaps more significantly for the Fed's inflation fight, average hourly earnings are forecast to have risen just 3.7% from a year earlier, the smallest annual increase in 3 years. This cooling in wage pressures could embolden central bankers to stay the course with further rate increases in the months ahead to fully restrain price dynamics. For its part, the unemployment rate is seen holding steady at 4.1%, the highest since late 2021 but still near historical lows, underscoring the labor market's overall resilience. How this jobless rate evolves will be critical for gauging recession risks. A continued drift higher, surpassing the 4.4% threshold that has accurately presaged previous downturns, could amplify market fears that overzealous Fed tightening risks tipping the economy into an outright contraction. Importantly, details within Friday's report may offer clues on the underlying health of the jobs engine. A sustained rise in labor force participation, for instance, could suggest the higher unemployment readings simply reflect more Americans actively seeking work, a positive sign of economic dynamism. The employment trajectory will also likely hinge on evolving immigration patterns, having benefited from a surge of new arrivals over the past 2 years that bolstered payroll ranks. If border crossings tail off as expected, companies may need to increasingly turn to automation and efficiency upgrades to fill staffing needs. At its core, the jobs narrative encapsulates the eternal tug-of-war between the nation's dueling economic priorities, curbing unacceptable inflation while sustaining full employment and upward mobility for all Americans. It is the grand challenge of our age, striking that delicate balance to usher in an era of prosperity and opportunity not seen since those idyllic days when the working class could quite literally build the American dream. The archetypical blue-collar worker may be an endangered species in today's services-dominated economy, but their spirit, that reservoir of grit, determination, and resilience, lives on in today's dynamic labor force. As the macro environment keeps churning, those intangible qualities will prove invaluable for a 21st century workforce perpetually navigating uncharted territory. The white clapboard may be a relic of the past, but the pride, dignity, and upward trajectory once represented by those structures must endure, the animating ethos propelling our economy into an era of broadly shared prosperity.